As unpredictable US trade policy keeps investors on edge, we see signs that capital is seeking a new home. Europe, despite the last few tumultuous years, could be emerging as a destination providing the relative safety that investors need and the US now lacks. But what are the pitfalls for European countries to avoid? And what are the opportunities for energy investors to keep their eyes on? You're listening to Energy Bites with ELS Analysis. Welcome to this week's episode.
Hi and welcome to a new episode of Energy Bites with ELS. It's Tuesday, April the 1st. I'm Elina Kinsey and once again I'm your host for this weekly podcast. For this episode, I'm thrilled to be joined by Samuel Chisuk, Carl Rosenberg and Siddharth Iyer. Hi everyone, how are you?
Hello.
Very well, thanks.
Very good.
Good, thanks.
So today we are going to discuss something that I believe we all feel quite excited about, and that is the shift we are sensing in the global investment sentiment. We are seeing capital flows being redirected to Europe in a way we haven't seen in recent years. We are seeing a growing interest in European infrastructure and energy projects, and in just a few months, Europe has become an interesting investment destination from an economic growth perspective. This shift is due to the region's monetary policy, but also the recent fiscal policy shift from several key European governments, which could be said to be the significant change here. We discussed this in last week's episode, where we focused on Germany's newly launched defense budgets and its related stimulus packages concerning infrastructure and energy spending. But now let's take a broader perspective and look at Europe as a whole and energy investments in particular. What are the underlying factors to this change in sentiment and the renewed interest for Europe? In terms of energy, where do we believe investments will go? Let's start with you, Sid. What's your thoughts about this?
Of course, Elin. So, as you rightly pointed out, there's a change in monetary as well as fiscal policy in Europe. In particular, that the monetary policy involves quite aggressive and bold rate cuts from the ECB, as compared especially to the Federal Reserve in the US, which has maintained fairly high interest rates for a number of years now. And that lower rate in Europe should lead to increased and easier access to capital, allowing investors to take more risks with less downside. And already last year, we saw growing interest in European investment from infrastructure funds. The US was top of the ranking there, with most trying to increase their exposure to US investment, but Europe was not far behind. And with Donald Trump taking office in the US and removing a lot of stability from the investment environment there, the willingness of investors to shift towards Europe would certainly have grown since then. And in terms of energy investment, it will be driven to a great extent by the stable demand outlook for Europe generally. But this is, of course, bolstered by strong fiscal policy underpinned by long-term goals for decarbonization and the like.
So could you just go a little bit deeper into the structural sort of change or differences between the US economy as it is now, I would say, and the European one? I mean, we did talk about that, like I said, in my introduction, or about what we talked about last episode about the defense sort of spending proposal that the German government or incoming government was presenting 2 weeks ago. But I mean, these has been reactions to what we have seen in the policy shift in the US. Could you just kind of just give us a sense of what are the big differences here when we're talking about economic growth? Are we then foreseeing, or are at least investors foreseeing, a stronger economic growth in Europe as a result of these different sort of policy shifts that we've seen?
Well, certainly the growth is expected to be fairly stable, more perhaps than strong. Stable would be how I'd describe it, in a sense, because the US generally is a more risk-taking economy. Like, much of the savings there are in riskier assets, including stocks, essentially, while in Europe, much savings are in safer assets, debt, bonds, this sort of thing. So that leads to the US just structurally having quite a strong growth, but at the same time, that growth is fairly risky in a sense. And so that, coupled with the uncertainty of policy that has been in that has come into effect in the past 3 months or so, is what is leading to a flight of capital to safety. Now, traditionally, safe investment has tended to be more of the U.S. market, but that seems to be changing, which appears to be a structural change to a great extent, and more stable European long-term policy is appears to be drawing infrastructure investment.
Yeah, and I think it also has to do with timing, right? So the policy that is introduced now by the Trump administration has some effects on driving up inflations in the short run. But what he's saying is then, well, we will see as a result of what we are doing now, we will see a stronger growth for the long term. But I mean, the combination of a slowdown in growth together with an increasing inflation is, we are coming into the risk of stagflation. So that, I think, is what many worries about at the moment. I also think it's interesting to see that there is a shift in which sectors we are seeing investors going into, going from very tech focused to more like these, stable, heavy, I would say, sectors such as infrastructure, in energy, defense, these kind of sectors. And I believe then Europe is providing more of a sort of a push, at least, for, stimulating those sectors. Would you agree with that?
Yes, certainly. With these stimulus packages that are coming out, not least in Germany, we expect to see the growth of new sectors within Europe, which yes, would be a change from the past, and in that sense, provide a fairly stable sectoral growth that should underpin not just, of course, defense, but also energy and broader infrastructure that goes into a secure continent, and that's reflected in policy to a greater extent.
So on that note, if we look a little bit more into energy, Sam, we are seeing an increasing interest for the reason given by Sid into sort of directing capital into infrastructure and energy. But energy is such a broad spectrum here. So if you give your view on where do you think this money will go, the low-hanging fruit, obviously, in the beginning, looking at low-cost projects, but we also know that there is a ceiling to how much you can build out onshore wind, solar. We have to sort of going up that ladder into more offshore wind, nuclear, those high-cost technologies. Where do you think, and also like to stress here that we are getting a sense of seeing capital going into Europe. We are not seeing these big waves of just money fleeing away from the US into Europe, but we are getting that sense, or we are seeing signals about that. But can you give your view just on where do you think this money will find its destination?
Yeah, indeed. And I mean, it's as you say, it's early days, and I remember after the great financial crisis, when we started to see a recovery, people were talking about green shoots, and maybe it's time to talk about green shoots in Europe, sort of for infrastructure investment. But I do think, we're starting to see this big trend, perhaps, hopefully, which mirrors what we saw the great outflow when the Biden administration launched IRA. Then, that's great, but those initial money, they will probably look for the least risky projects, those that are most straightforward, where demand is most certain, prices, etc., etc. So I think onshore wind will be a natural target in throughout most of Europe. Solar, obviously, solar has done pretty well actually, even in the last few years. Batteries, wherever opportunities exist in the markets and so on, flexibility, those kind of things, those kind of innovation, which has a lower threshold sort of capital wise, are low-hanging fruits. But I do think, and here is, of course, where you stop being able to talk about Europe as one big group, where you have to look at different markets. Those governments that have been proactive with good regulations, with good support schemes and structures, will be able to also attract those projects that are sort of further higher and higher up that risk curve. And we talk about obviously offshore wind in this case. And I think those who already were able to attract some investment in the last few years, they're in the best place to continue attracting that investment. That means that parts of Western Europe like France, the UK, Germany might be in a better position than most of the Nordics, for instance, that struggled so far, where markets probably will demand some more de-risking to happen. And I think if you look further up that ladder for those that really crave stability, nuclear, that will also definitely be the case. Those that properly de-risk, they will get the investment.
And again, I think here it also has to do with timing. So we seeing these sort of defense plans, and which will be this big engine here for the growth that we are now seeing, getting these capital going into Europe, or at least what we are foreseeing. These plans will have to materialize quite soon. We will not have time to wait for these huge, big projects coming on stream in 15 years. This will have to be a build-out that happens at least, in the medium term. So I guess that also feeds into this low-hanging fruit and this sort of risk ladder, or risk, where you kind of go up through this structure. So I think that also plays in here. But I would like to just challenge you a bit here, because I do think that even in the Nordics, perhaps we don't have the best conditions for investing in new production, but we are very close to these huge demand centers such as Germany, such as these continental European markets, which just cannot be self-sufficient on this new production. So will there not be sort of a push for investments into new energy production in the Nordics, just as a supply sort of destination, rather to supply the demand centers further down on the continent? Or what's your view on that?
No, I actually think that will be a part of the lure to get investment in, but it needs to be, there's still a few steps that need to be taken regulatory wise to make that possible, and particularly when we talk about larger projects like, for instance, an offshore wind. Well, you'll have to be able to build it in a way so you can actually sell to those higher prices that those markets, that demand is offering. So you need to be able to capture that in one way or another. And of course, with either sort of depending on bidding zones or where the governments allow these investments to happen, that will be very crucial for something like that to happen. I mean, where one is, where there is a possibility actually that the market could solve this regardless of political impetus, is maybe in e-fuel projects and in the hydrogen economy. Again, politics would need to at least in some way, some easy way, sort of make export opportunities available. But at least that could be a way to monetize power production, particularly more expensive power production than maybe in the adjacent bidding zone, if we talk about, for instance, northern Sweden or those kind of areas.
Yeah, so you are mentioning politics a lot. You're mentioning regulatory risk, political risk here, that we are seeing sort of a huge fragmentation within Europe. Carl, on that note, how do you see the political landscape for unifying Europe and actually be Europe managing to push these big plans ahead? Could you give your view on that? Are we seeing a unified Europe that just are all for rearming Europe in one particular way?
Well, I would say that from an investor sentiment point of view, that the European fragmentation risk has, at least the perception of it, has lowered. A lot has happened since the turn of the year. That said, Europe is under immense pressure, which could, of course, trigger fragmentation. And that pressure was already spelled out in, we can take Mario Draghi's 2024 competitiveness report as an example. And in response, the European has rolled up a new competitiveness roadmap and a compass and a clean industrial deal. But, economic concerns are only part of the story here. European leaders were seriously shaken to the core by, Trump's direct outreach to Putin, by statements from Secretary of Defense Pete Hegseth, suggesting that Europe is no longer a US security priority, by J.D. Vance's public criticism of European domestic politics, which ultimately has resulted in peace negotiations on Ukraine proceeding without a European involvement. And all of this is, points toward that there's just going to be a difficult period in US-Europe relations under the second Trump administration, with growing tensions across trade, climate policy, defense, tech regulation, of course, China. And I think a lot of us were seriously watching closely to see how the EU would respond. And so far, it has responded, but not without still being under pressure. We saw a serious turbulent elections during 2024. France held snap elections that resulted in a fragmented parliament. There was a historic move in December that brought, the first successful vote to oust the French Prime Minister Michel Barnier from office, and of course there were real worries. So in Germany, in the run-up to the election, with financial pressure, and of course the ruling coalition ultimately fell apart. But now we're sort of on the other side of it, and we're seeing stabilization, with Germany laying out its new defense and infrastructure plans. So we're seeing some light I'm not saying we're out of that dark tunnel, but there is some light there.
Yeah, so kind of we found in Europe a common enemy, and then we unite to battle that challenge. But we also have seen a big move of right-wing populism in Europe. Many of those have been good friends with Trump. They have quite different views on Ukraine, if you're looking into that spectrum of everything on the right-wing side. We have also seen them changing position after Trump kind of have launched this very anti-European policy. But could we talk about this division within this right-wing populist movement in Europe as well? Because I think that plays a crucial role in having an outlook whether we will be able to unite ourselves in Europe and focus and prioritize on those things that is very important, at least for the EU Commission at the moment, to rearm Europe and repower Europe. We know that there is a strong link between right-wing populism and climate skepticism. But now it's no longer about the green transition, it's necessarily no longer about sort of fighting climate, but it's also about rearming Europe. So can you give your view on sort of how do we see this different, or are we seeing a fragmentation within the right-wing side of politics in Europe?
I can just briefly mention that, the European Parliament itself is quite fragmented. I think a lot of people have talked quite extensively about it's much more difficult than in the last mandate period to get through policy in the Parliament. So the policy making process in itself will be more troublesome during this mandate period, but absolutely, it's not a done deal, despite us having a common enemy, so to speak. All European parties are not united under this. The European right-wing populists and maybe the less left ones as well there are fractions there. But if you focus on the right ones, on one side you do have national populists who are ideologically wary of both American and Russian expansionism, who reject outside influence on politics from foreign actors across the board. But then, of course, there is another strain, populists who, regardless of the source, are sort of drawn to the critiques of the current European establishment. And for them, it's less about having a coherent foreign policy and more about fueling dissatisfaction with Brussels. And that tension means that while the EU has made progress with regards to defense policymaking, the ground remains politically unstable, and that could reintroduce fragmentation, and that could reintroduce a volatility into both policymaking and, of course, the markets.
Do you have any comments about this, Sam? Do you, if I pose a question like this, do you see that Carl is now talking about sort of separating the right-wing parties into two groups here, the ideological driven ones and the more, I would say, traditional populist sort of driven fraction of them. Where do you see sort of the power balance between these two groups lying? I understand that it's not that straightforward, but I think it has a huge impact in EU's ability to unify. So it would be interesting to just hear your view on this.
Yeah, I think I definitely think you're onto something there, Carl. I think there's been this populist infatuation, obviously, with MAGA in North America, because a lot of it is seen as narratives that they would like to pick up and bring into Europe, and they are sort of thankful to bring into Europe, and this kind of let's just wreck the elite, right? And that as I think as it becomes a bit harder to sell that. Because it loses its luster, those groups will be somewhat weakened, while those that are sort of have a more of a nationalist bent, proper one, will of course they won't struggle so much with the fact that now we are under attack. Let's band together with the countries closest to us. And try to solve it, because we are under pressure. We need to rearm. We need to make some tough decisions. So I think those can actually start to compromise a bit with the general populist notion that after all, it's more bread and butter than arms or green energy for that sake, right? And they will those that are purely nationalistic might actually be able to stomach that kind of environment better.
And also, I think it will come down very well with their voters. And I think that is also kind of what ground do they have for this position with their voters. And then I think this last one that you were talking about, the last group here, has a better support from the voters in general. But Sid, when you're hearing now Sam and Carl talking about this sort of political part of this discussion, do you see the last month since Trump entered into office that the political risk has increased or decreased in Europe, that will say, and then in particular then investments into energy and sort of the investment climates in general?
Yes, of course. So, as we've kind of touched on this week quite a bit, there is some level of unity building within Europe, especially in response to Trump's actions and statements. And the unity building in Europe is certainly a positive. I mean, it points towards bringing markets closer, making it easier to cooperate and collaborate within Europe, which would certainly be a great positive. Now, that's coming on the back of quite a lot of populist rhetoric earlier on, and spilling over very much into energy, like up here in the Nordics, like a lot in terms of reducing exports, being very much keeping Nordic energy within the Nordics. That's one side of it. But with more stimulus coming in at the continent and a need for more unity within the continent, there is a lot of potential for that sort of cross investment across Europe, and as long as that's picked up in a good way within the political sphere, there's a lot of potential for positive growth throughout Europe. But then that said, there does need to be some unification, some merging. Like, for example, capital markets are quite splintered. Even if investment would like to sort of come together on many fronts, there's still some difficulty in achieving that. But there are movements to try to make it easier to have like a common European sort of capital market. It won't be 100%, but every victory on that front is helpful for investment in Europe.
So if I'm posing the same question to you, Sam, I'm aware of time now and we are running out of it. But if I'm posing the exact same question to both you, Sam, and Carl, and then we'll finish off this podcast by just giving your view. Do you think that political risk has increased? Now I'm talking from the same perspective as I asked Sid about, like a European perspective, investments going into Europe. Do you think the climate for investments have been hit harder by political risk during the last few months, or has the political risk decreased?
I think the political risk has decreased relatively in Europe compared to other areas, and that is because we have seen the geopolitical risk go up so much, but we also have the trade risk with the US, etc. So basically, it's become much worse in several other areas, which has made Europe look better, even though we are under pressure and we are under geopolitical stress. Hence, we do need to do things, but we are coming together, and that in itself brings a certain level of de-risking.
And to be very kind of sticking my neck out here, we are capitalizing on the fact that the political risk perhaps has gone up, or rather the reaction from the European side has benefited our position on the global stage. But Carl, could you give your view on this?
Well, the euro hit a 4-month peak, right, against the dollar early in March. So we have the answer to that already, don't we? No, but I agree with both Sam and Sid. I think a lot of the fear that dominated the late 2024 and I guess early 2025 is starting to ease. Markets have reacted quite positively to yet again a coherent European stance. Many expected Europe to be fragmented already in the beginning of the Ukraine-Russia war. So that's helping to reduce the risk and the political fragmentation.
Thank you so much, everyone, for this. This was a very interesting discussion, and I'm looking forward to follow up on this the coming weeks and months, because I think this is this is a bit of a game changer, even though we won't see sort of, flows or sort of very, very big changes, in the short run. But at least I think we are identifying a shift here, and I think it will be super interesting to follow this going forward. So thank you so much for this week's podcast.
Thank you.
Thank you.
Thanks very much. Bye.
Bye.
Thank you for tuning in to Energy Bites with ELS Analysis. To know more about our advisory offerings, email us at els@elsanalysis.com or visit our website www.elsanalysis.com. Follow us on LinkedIn to stay up to date on our latest activity. We wish you a good and productive week ahead.